Good morning, everybody. My name is Scott Isdaner. I'm the managing member of Isdaner Company, and I want to welcome everybody here today. To start, I want to thank all of you for your kindness in enabling us to do this a week later than we anticipated. Last week we were in significant competition with a couple million people down in Philadelphia, so we chose to hold this off for a week. As our note said, we punted in favor of the Eagles. So thank you all for being able to join us on such short notice. The purpose of today's meeting is for us to have the opportunity to share with you an oversight of the new tax law that was passed and enacted at the end of last year. Four of us will be making presentations today. Ed Doran will be talking about the individual tax changes in the new law. Leena Ritchie will be speaking about the business changes. I'll be speaking about one provision in the law dealing with pass-through entities. And Arthur Zatz will be bringing up the rear with discussions about international as well as a whole slew of other miscellaneous and ancillary provisions in the tax law that have some significant impact. The law is extremely sweeping and is truly in many ways reform, in some areas simplification, and in some areas far more complication than we ever anticipated, and as you'll see today, leaves more questions to be answered than there are in the law as currently written. For the most part, the new law is effective starting this year, although some provisions do impact last year, and there are some provisions that do not become effective to future years, and we'll highlight them where they're relevant. But for the most part, keep in mind, most of what we'll be talking about is effective for the 2018 tax year. I believe for those of you who are eligible for continuing education, CPE, for accountants, there's a sign-in sheet that will be outside. Feel free to sign in when you leave, and we'll make sure that certificates are given to you. And as a panel, we're welcoming questions as we go along, but I'm going to reserve the right to cut them off if the questions start overwhelming our ability to get through the material, and then we'll take questions at the end. So let's get started. As we get started, if you do have questions, please raise your hand, and we'll take the questions as we go along. Before I turn this over to Ed, I just wanted to briefly give you a little lay of the land. There were two competing tax bills that were funneling through Congress during the fall of last year. The House passed their provision in November. The Senate passed their provision in December. For the most part, following a conference committee meeting where the House and the Senate met to reconcile the differences between their bills, which were very significant. For the most part, the approach adopted by the Senate was utilized in the final form of the legislation. It was passed by both houses after the conference committee resolved the differences. That happened in December, and then it was signed into law by the President on December 22nd, and as he said, it was his Christmas gift to America. You'll be the ones who get to judge whether you view this as a gift or not. In many cases, it will be a nice gift, and for others, we'll have to wait and see. It's going to be very individual as to how people are impacted by many of the provisions in this tax bill. We leave the last item there so that you're aware. This was a very hastily enacted piece of legislation. There are a lot of drafting questions that have come through for those of us now that are going through the details. We are going to be waiting for a significant amount of clarification and guidance, both from the Treasury Department, and my guess is there's going to have to be some sort of technical corrections legislation at some point to fix some of the uncertainties and inconsistencies that exist in the law. But we're going to talk today about the broad strokes of the things that we know are, in general, what's going to be happening, what to be on the lookout for. So with that, I'd like to turn it over to Ed, who will start talking about the individual matters.
Okay.
There you go.
Perfect. Good morning, everyone. As Scott said, my name is Ed Doran. I'm a tax director here with Isdaner Company. And one of the areas that I work in is individual taxation. So I'll be taking you on a tour of the individual tax changes in the Tax Cuts and Jobs Act of 2017. Doesn't exactly flow off your tongue like the good old days when we had the Tax Equity and Fiscal Responsibility Act. You had an acronym TEFRA. I don't know what we're going to use for an acronym on this one, so JICTA or whatever, but doesn't flow off the tongue. I'm a little nervous because I usually walk around when I talk, but I'm kind of landlocked here. When I've spoken in this room before, there were tables further apart, and I would go down the middle, so I still may do that. So if anyone tends to get seasick or anything like that, or the videographer is going to be running me all over the place, I am going to walk around a little bit. Hopefully that won't affect anybody listening to what I'm saying. Most of the changes I'm going to be talking about are not that complex. They're not really complicated areas. These guys are going to handle the heavy lifting. They're going to be talking about some heavy duty stuff, so you'll be begging for me to come back when those guys start talking. So I've attended a lot of seminars in my career, and I've given some over the years. And I know when someone presents, they usually start with a joke or a perceived joke. I've never done that, but I'm going to try it now. So I'll know in a few seconds whether it's a perceived joke or not. So the guy goes in to see his doctor. He says, "Doc, you got to help me out. I keep having these crazy dreams. One night I'm a wigwam, the next night I dream I'm a teepee. Wigwam, teepee." He goes, "It's been going on for months. Wigwam, teepee, back and forth." He says to the doctor, "Got to help me out, Doc. What's wrong with me?" Doctor said, "There's nothing wrong with you. You're just too tense." Let it sink in. Let it sink in. Too tense. Okay? Some people not laughing. I was going to use Mona's joke if that didn't work, but one's enough. Okay, so let's get started to the good stuff. First, tax brackets. The core of our individual tax practices are tax brackets. You figure out your income, you figure out your deductions. Okay, how much tax do I have to pay? Prior to the Act, there were 7 tax brackets. After the Act, there are 7 tax brackets. And you can see on the screen, though, other than the 10 and the 35%, most of the brackets have decreased. And the top bracket has gone from 39.6 to 37%. I've been doing taxes for a long time, and I would have liked to have been in the room when they were arguing about the tax bracket and came up with the 39.6. Let's make it 40. No, let's make it 39. But no, it's got to be 39.6. Whoever yelled that out. So I don't know. I guess it came up with a lot of money, that extra 1%. The next screen just basically walks you through the levels of income where the tax brackets kick in. This isn't going to take effect, like Scott said, until 2018 tax returns. But the bracket breaks are pretty much the same as they were prior to the Act, but the brackets are just lower. The next talks about long-term capital gains. The Act has retained the preferential tax brackets for long-term capital gains. Long-term capital gains will be taxed at 0, 15, or 20%, based on the level of income.
Is that AGI or taxable?
That's capital gains, the number of the amount of capital gains, exactly. Also, the net investment income tax has survived. If anybody's familiar with this, that's the additional 3.8 Medicare tax that's on top of your normal tax rate when your investment income, interest, dividends, capital gains exceeds a threshold amount. And you can see on the screen what the threshold amounts are for the different filing statuses. With the new Tax Act and the retention of the investment income tax, the highest marginal rate now would be 40.8%. The 37 plus the 3.8. If you're all capital gains, the highest you'll be is 23.8. Next, standard deduction. This probably got the most press when, like Scott said, there was the House bill, there was the Senate bill. They were talking about changing the standard deduction. And what the Act did is it increased the standard deduction. Now, the standard deduction is if you don't itemize your taxes, if you don't itemize your deductions, you take a standard deduction amount against your taxable income, against your income to arrive at taxable income. And if you see on the screen, In 17, for married filing joint, the amount was $12,700. It's almost doubled to $24,000. And the same goes for the other filing statuses. The standard deduction has increased, almost doubling for all the filing statuses. Now, that's a nice thing. For people that don't itemize, they've got a nice deduction against their income. So we can say, hey, nice Congress, nice president, all that good stuff. But as Congress giveth, Congress taketh away. Personal exemptions. Everyone has a personal exemption for tax purposes. I have one, you have one. Everybody has a personal exemption. My wife has one, my 2 daughters have one. Okay? We don't have one anymore. They took away the personal exemptions. In 2017, the amount was $4,050. For a married couple with 2 children, that amounted to $16,200 of a deduction against income. Gone. No more personal exemption. So they gave you a standard deduction, then he took away your personal exemption. The Act also retained an addition to the standard deduction for blind and elderly. That was an additional amount you could add on to your standard deduction, and that's been retained in the Act. I said, nothing real earth-shattering here.
$1,300 for married and more for unmarried?
Correct. I checked that. That is weird. Scott asked me that, and I checked it, and it is correct. Whew. Jumped the gun on that one. Okay, go ahead.
Elderly is what?
65 or older, yes. It's the same as it was before, when you do a 10-4. You put check the box for 65 or blind or whatever, and it'll give you the extra amount of standard deduction, the additional amount.
It's on the standard or it's an
It
exemption?
it's added to the standard deduction.
So you're saying the standard deduction plus the old exemptions might have been more for some taxpayers than the current.
Here we go. Let's look at this. Darren's bringing us into the next slide. Some people are going to get helped by what happened. Some people are going to get hurt by what happened. So look at the first one. You have a single taxpayer. In 17, they have a standard deduction of $6,350. They got an exemption of $4,050. They had 10-4. Now they got $12,000. They're happy. All right? Had a household with 1 child. They got a little bit of a benefit. They got 18 now compared to the 17,450. Had a household with 2 children. Not so happy. In the past, they had 21,500. Now they only have $18,000. Now we're talking about non-itemizers. These are people using the standard deduction. Married filing joint with no children. Got a little bit of a bump. Better with the new tax law. Married filing joint with 2 children. My situation took a hit. All right? I'm going from 28,900 down to 24,000 if I didn't itemize deductions. So some people are getting help. Some people are getting hurt by this. Yes.
I just want to mention that, for a lot of people last year, high net worth, their personal exemptions were phased out anyway.
Well, we're going to talk
Right,
about.
so I'm just saying, so
Exactly.
maybe the standard deduction really is a better thing.
Exactly.
Because they didn't get the benefit last year.
Exactly. Exactly. Okay. Let's move on to itemized deductions. We were talking about a standard deduction. Now you can take the standard deduction or you can itemize your deductions. One of the itemized deductions is medical. The medical deduction for years and still has a floor. And basically that means you have to exceed a certain amount of medical expenses over this certain amount in order to take the deduction. For years it was 7.5%. I think a few years ago they changed it to 10%, but they left it at 7.5% for people over 65. Why make it simple? We'll just keep complicating things. So the Tax Act now says for 17 and 18, the floor is 7.5%. In 19, 10% of AGI, assuming nothing gets changed before then. Now, I was actually meeting with one of our referral sources for lunch a few weeks ago, and we were talking about how this medical mostly affects elderly people. They may have retirement communities, part of the medical deduction and things like that. And we were talking about our families, and my mother, a week ago, had her 95th birthday. And she doesn't use glasses. She drinks right from the bottle. Okay, tough crowd. All right. Taxes, another one that got a lot of press. A lot of people had real estate taxes. You had state and local income taxes taken out of your pay, your estimated tax payments. They were big numbers for tax deductions, all right? Now, state and local taxes are limited to $10,000. That's the most you can take as a deduction for state and local taxes. Now, the warning at the bottom says, I think a lot of people know, we were telling people to try to prepay their real estate taxes, which is fine, but if anybody tried to prepay their income taxes, they're going to have a problem. I'm not quite sure how they would do that unless they made an 18 estimated payments in December of 17, I don't know. But if anyone tried to do that and the tax related to the 18 tax year, they're going to lose the deduction.
I didn't think in Pennsylvania you could prepay your real estate.
I'm not sure if you can, I mean, I think some people did it.
Well, it actually depended on the jurisdiction.
Yeah,
For instance,
exactly.
Philadelphia did assess and issue tax bills before the end of 2017. So for clients of ours that lived in Philadelphia, they typically would pay in February. They were able to make prepayments in December if they were able to get a benefit from the additional tax deduction.
And I think in New Jersey too, people were, I think the localities were saying that some of them wouldn't let them do it. And I think the governor put out something before the end of the year that told the jurisdictions, if somebody wants to prepay your taxes, take it. I think I saw something that Christie did before the end of the year, some kind of governor announcement that says, we have to do this. Okay, sticking with itemized deductions, home mortgage interest. It's a deduction that a lot of people take. Prior to the act, if you were lucky enough to have $1 million home and you had $1 million acquisition indebtedness, you could take all the interest associated with that $1 million of indebtedness. If it was over that, you'd have a problem. You could also take interest up to $100,000 of home equity interest. So it was roughly $1.1 million that you could take for home mortgage and a combination of that and home equity debt. For the new act, the amount is now $750,000. So if you're lucky enough to buy $1 million home in 2018, you're not going to get the full interest deduction. You're only going to get about $700. You're going to get, what, 3/4 of what I guess, 75% of the number. Now, it's grandfathered in. The $1 million is grandfathered in. So people who, again, who are lucky enough to have $1 million home or still have $900,000 of debt, they don't have to worry about the $750. They can still use it. If you're buying homes in 2000, I think it was 12, 15, 17. If anything was purchased after December 15 of 17, you're under the new law. Any questions on that?
Home, existing home equity
No.
for prior to 12,
Home equity is gone, starting in
even
18.
if you purchased it prior to 12.
Even if you took out the home equity debt prior to that. Right. Now, we kick this around. A lot of people will take out home equity debt to make substantial improvements on their home. I think we want to try to make an argument that that's still deductible because it's kind of like acquisition indebtedness. But if you took out a home equity loan and you bought a boat and you bought a car and you paid for education, it's gone. You can't take that again anymore in 2018. Casualty losses. We don't see this a whole lot. We did see a lot of it in 2013 with Sandy. Don't see it too often, but if you had a casualty loss and you were still short after you got your insurance refund, you could go to your tax return and try to file a loss, but it had to exceed 10% of your adjusted gross income. So most people got insurance reimbursements. If they did be short on the reimbursement, when they got their tax return, it didn't exceed 10% of their adjusted gross income, so they didn't get it. So we didn't see it a whole lot, but it doesn't matter because it's gone now. Personal and casualty losses are gone except for federally declared disaster areas, which I believe Sandy was. So if another hurricane hits, down in Florida or wherever, and the area is declared a federally declared disaster area, you can still take the personal and casualty loss. Still subject to the 10% of AGI though. That's stuck around. Sticking with itemized deductions. Miscellaneous itemized deductions. You can see on the screen what they are. Investment advisory fees, employee unreimbursed business expenses, tax prep fee, and a lot. You could deduct these on your tax return to the extent they exceeded 2% of your adjusted gross income. There was also a floor on miscellaneous itemized deductions. But a lot of people hit over that floor and were able to deduct these. Gone. Gone for 2018. No more miscellaneous itemized deductions for after 2017.
Does that include the write-offs from 1041s and those in the state?
The excess deductions on the termination of a state, I believe they're subject to the 2% floor. Yeah, so that would be included. Now, there was one more thing. Pennsylvania. Even though this is federal, Pennsylvania still has a Schedule UE, unreimbursed employee business expenses. So your employee unreimbursed business expenses, bullet point number 2, would still be good. Home office expenses, union dues, you can still take them on Pennsylvania. Pennsylvania didn't disallow them. So, don't throw your logbook away where you're keeping track of all this stuff. It's just not going to happen on the federal return. I think Mitch was mentioning something about the phase-outs. Prior to the new act, if you did have personal exemptions and you did itemize your deductions, when your income got to a certain amount, they were phased out. People with a lot of income, their personal exemptions sometimes disappeared. They didn't get anything for the personal exemptions. Higher income, part of your itemized deductions, you would start losing it. In 2018, both of those phase-outs are gone. No more phase-out of a non-existent personal exemption, which is good, and itemized deductions will not phase out anymore, no matter how high your income is. Child credit. In the past, there was a $1,000 credit for children under the age of 17. There was a phase-out, same as we talked about with the itemized deductions. If your income exceeded a certain amount, you lost your $1,000 child credit. The new act basically says, we're going to let you take the child credit, but now it's $2,000. And you can see at the last one there, the phase-out has now jumped to $400,000. In the past, for married filing joint, it started at $110,000. So a lot more people are going to be able to take the child credit that weren't able to in the past. And I think the reason for the increase was supposed to make up for the fact that we're losing our personal exemptions. I mean, every situation's different. And luckily for me, for 2018, my oldest daughter turned 17, so I'm not going to get anything anyway because it's for under the age of 17. Luckily, I have one younger than 17, so I'll get something out of this. And also, the credit was mostly non-refundable, and what that meant is it could reduce your tax liability, but if it reduced it higher than your tax, you weren't going to get a refund. Now you can get up to $1,400 and just refund it. So this is a nice little tip for everybody.
Where's the phase-out begin and end?
For married filing joint, $400,000.
It ends there?
Oh,
or
I'm not
starts
sure, I
there?
don't know where, it starts at $400,000, yeah. And that's for married filing joint, I think all those it starts at $200,000. Scott has the book, he could,
So what if your child's in school still, you don't get that?
no, it's under age 17, children under age 17. This one doesn't affect you guys too much, it's more of a due diligence, it's for us. If we have somebody claiming a head of household status, the IRS, so you guys better make sure that they are head of household, because there are better rates than a single person. So we've got to answer and fill out a form that we ask this question, we ask that question, we ask this question, and they answer the questions, and we attach it to the tax return. So we're pretty much policing ourselves. With the head of household, earned income credit, that was there before, the child tax credit and the American Opportunity Tax Credit. The new act is adding head of household for due diligence. So now we got about 4 things we got to make sure that we're asking the right questions before we do it. Kiddie tax. Kiddie tax has been around for a while, if anybody's familiar with that. When it started years ago, it used to be for children under the age of 14. Now it's for under the age of 19, I believe. If they're in school between 19 and 23, over 24, it doesn't come into play. So basically what was happening is that if your child, if they fit into the kiddie tax parameters I just talked about, if they had unearned income over a certain amount, and I think it was $2,100, that would have been taxed at the parent's rate. So if you had a child with $5,000 of income subject to the kiddie tax, and you were in a 40%, 39.6% tax bracket, that would have got taxed at 39.6%. So the new law says, forget about the parent's return. We're not going to tie this kiddie tax to the parent's return anymore. What we're going to do is we're going to have it taxed on the kid's return, okay, but, next slide, these are the tax rates you have to use for kiddie tax. There are the estate and trust tax rates. And if you look closely at the earlier slides, I showed you can see how quickly this jumps to 37%.
So does that mean that if you have a child with, say, income of $1,500?
Unearned income.
That's fine, but you're gonna have to file a separate tax return for that kid because it's no longer.
Well, there's an exemption of $2,100. What I would suggest, if you got a kid getting a 1099 with $1,500 of income on it, I would file a return to avoid a matching notice. You may not pay any tax because there's a $2,100 exemption for the unearned income. If
Right,
that's
but
unearned.
the point is, you're actually filing a separate return,
Yes.
even though it's relatively.
Exactly. Well, even before this, when it tied to the parent's return, there was a separate return still filed. And the child attached a form, I think it was an 8615, where they calculated the kitty tax. And it said, bring over your parent's income onto this form. So you were filing a return for the child anyway.
Can you still elect to have that income recorded on the parent's return?
I don't think so.
That's what
I wouldn't think so. I didn't see anything about that, but I wouldn't think so. So anyway, you can see how quick it gets up there. But a lot of people may not get hurt with this because I don't know how much unearned income the children will have, but if your child has like $3,000 or $4,000, they're still going to be right around the 10, 24% bracket. And if you have a parent in a 37% bracket, you're making out better. If your child's income is in excess of $12,500 unearned income, well, yeah, it's getting taxed at the same rate you are. But, I mean, I think most of the ones we see, if there's not large capital gains, the earned income isn't that high, and now we're not pulling it onto a parent's return, so they may get the family unit may get a better benefit.
Is that sort of just that your kid has his own little brokerage account at Morgan Stanley with $100,000 floating around?
Because their ID number will be on that account, and they'll get a 1099 in their
That
ID
gets
number.
taxed, yeah.
Yeah.
I'm sure the smart people all have them in 529, which is not taxable.
You could have a 529 plan, exactly.
Yeah, you still have trust.
But we also see a lot of returns where kids have them in their own name, like you're saying.
You say it was a zero tax below $2,100?
There's, for the unearned income, yes, $2,100. I believe that was 17. I don't know what the number will be for 18.
The long-term rates, is it still going to be 0 in the 10% bracket and 10%
For
after
capital gain?
24?
For capital gain?
Yeah, so should you gain that if you want to drop some capital gains down to kids every year?
Sure.
Yeah. There's a lot of planning opportunities. They haven't changed. There's planning opportunities pre and post the Tax Act, but that's a good one that Darren's mentioned. So, and again, these take effect in 18. We got a whole year to figure out the best way to do this. So tax planning is always a good idea, and we're always here. 529 plan. Somebody mentioned the 529 plan. The change for the 529 plans in the Act is that qualified education expenses previously were usually college. Now it includes kindergarten through grade 12. So you have a kid in a private school, a child in a private school, high school, elementary school, you can now put it in, I use it to pay that if you have it in a 529 plan.
10,000 per year.
10,000, yeah, exactly, not per plan, per person. Did I get that moving my time here? Alimony. Alimony in the past. Taxable to the recipient, tax deduction for the person paying it, gone. Starting for decrees after 2018. I know Scott mentioned a lot of this happened in 18. This is for after 2018. So on the 18 returns, alimony would still be coming into play. Moving expenses, no longer deductible. Employee reimbursements are taxable unless members of the armed services. Put that caveat in there. Okay, I'm almost done. Alternative minimum tax, everybody's favorite. They were kicking around whether to do away with the alternative minimum tax for individuals. If anybody's familiar with the alternative minimum tax, it's like a parallel universe. You figure out your regular tax, and then you figure out your alternative minimum tax. Two separate tax calculations. Gets difficult at times. People get hit at the AMT. They're going, why do I owe so much tax? Because you're in the AMT. Hurt a lot of people. So what's happening now is, if you can see on there that it has not been repealed, it's still around for individuals, but the exemption amounts, if you get at the bottom of the screen, married, filing joint, the exemption amount is now $109,400. I don't remember what the number was, but it was lower than that prior to this. So you got a higher exemption amount and the phase out. Your exemption was also phased out if your income got too high. The phase out now starts at $1 million for married filing joint. So they're thinking with these adjustments, not many people are going to get hit with the AMT. But the more important thing that will affect our taxpayers, and these guys pointed it out, is that with the limitation on taxes being $10,000 and miscellaneous itemized deductions gone, that's where we saw most of our people getting thrown into AMT. They had to add back all their taxes for their alternative minimum tax calculation. Not deductible for AMT. Miscellaneous itemized deductions, not deductible for AMT. So all that stuff had to get added back, and that's why people were getting thrown into the AMT. Well, miscellaneous deductions are gone. So there's nothing to add back anymore from there, and the most you're going to get for taxes is $10,000, so you're going to add back $10,000. So that's probably why we're going to see less people getting hit with the AMT. Okay? And the last part is where Scott's going to come in later, pass-through businesses. If you own an S corporation, a partnership, or you're a sole proprietor, you get to take roughly 20% deduction against that income. I don't know if I'm using the right terms, but Scott's going to go into that and explain how that works. Okay. Any questions on anything?
Were there any changes to the investment interest expense?
No. Did not see anything about that, no. Any questions on anything? I would tell you a joke, Mona, but I think I'm out of time. All right, Leena.
Hi, I am Leena Ritchie. I'm a tax partner at Isdaner Company. I spend my days working on partnerships, S corporations, and C corporations. And I have a quick overview of what's happening to businesses. Let's see how this works. Here. I think that one of the things that we have heard most in the news is how the corporation tax rate has been reduced to 21%, which I think is substantial because it used to be 35%. And even taxable income, businesses in 2017 with corporation taxable income of $74,000, which is not a big number, they are taxed at 34%. So the flat 21% rate is really substantial reductions and does benefit C corporations. The same rate applies to personal service corporations. Personal service corporations are corporations like doctors, lawyers, architects that are formed as C corporations, and they were taxed at the flat 35% rate. And then on Pennsylvania is about 10%, so their tax rate was pretty high. So they get a big benefit as well, being taxed at 21%. Corporations are able to deduct dividend income that they receive. There's a reduction for dividends. That has been reduced a little bit. That's not, for most corporations, a big deduction at all. Corporate AMT has been eliminated, which is wonderful. And then also domestic production activities deduction is eliminated. That's a deduction that manufacturers, construction companies, producers were able to take. It was 9% of their qualified production activities income. So for some businesses who manufacture, produce, do construction, that was sizable deduction, and that is gone effective 1/1/2018. Another thing that this new legislation change is net operating losses. For businesses, if you have a loss for the year, you were able to carry it back 2 years and then forward 20. Now they eliminated the carryback altogether. So let's say that 2018 you would have loss, but 2017 your corporation income would be high. You cannot carry that 2018 loss to 17 and get money back. It only can go forward. And they also reduce the amount of loss that you can use. It can't be more than 80% of your taxable income. So C corporations, every year, they do have to pay some tax.
Look, Leena, just to comment, this also applies to individuals, these same changes with respect to net operating losses.
Yeah. Other thing that is confusing, they really are changing the rules for meals and entertainment. They're really tightening them a whole lot. Basically, what is left is that you still can deduct meals when you have business meals. You can deduct 50% of that, but many other entertainment-related expenses are no longer deductible. Then there are some, what I would call, small business changes that,
On the entertainment, what if you had a business meeting with the entertainment?
if it's in any kind of a facility, if you go to the Phillies game and you have a box, no. But if you just have meals at the restaurant or somewhere, that is deductible.
Sports teams aren't gonna like that.
No, there are lots of people who are, no, any kind of a facility or meeting, yeah. I'm sure we're going to get more clarification on what is exactly deductible and what isn't. Basically, they say that 50% of business meals is still deductible, everything else is gone. On the accounting changes, there are quite a few, what I would, some people call small business. These are changes that affect any type of entity. Business entity, if their gross receipts for the past 3 years are $25 million or less. What it used to be, and it still is for 2017, since we're working on 2017 returns, that if you're a C corporation or you're a partnership with a corporation as a partner, you had to use accrual method of accounting. Now you don't have to do that anymore. Any entity, if gross receipts are less than $25 million, you can be on a cash basis. The same thing, even smaller businesses, they have inventory and they need to do inventory accounting. The same thing, 25 million or less in gross receipts, you can call your inventories materials and supplies, or use whatever method you use on your books and records, which means also that you are able to use cash basis. Another thing I think really is good is that relief for the UNICA rules. Many of you who are resellers or manufacturers have to deal with these uniform capitalization rules, which are very cumbersome and time-consuming. It doesn't matter what size business you are, if you manufacture, produce something, you were subject to these UNICA rules, which in effect you had to capitalize expenses more than you did in your financial statements. Even if you used full absorption method of accounting, you need to capitalize additional G&A cost into inventory. And often the amounts were small, but you had to go these convoluted calculations. So I think that that is relief for many small businesses. For resellers and wholesalers, you escaped this rule if your past year's gross receipts were less than 10 million. So all the 25 million number comes here again, so you have a relief. The only thing is that if you want to change to the new method in any of these, it's considered a change in method of accounting, and you need to file a form and adjust your taxable income for the past years. Yes, you do need to do that. And also, some of the construction companies, there's more availability used completed contract method.
I have a question about entertainment expense. So if you buy tickets to a sports event and you take somebody to that event, and you typically prior to now would deduct at least a portion of that because it's an entertainment expense. Under the current new laws, entertainment expenses are no longer deductible, so you can't deduct that.
Yes. On the current law, you can deduct the face value, not if you go to the Skybox or Superbox. It had to be the standard ticket price, yeah.
So you're taking a customer that you're taking somebody that refers business to you. Why can't you call that a marketing expense?
I'm not going to.
Iris will call it an entertainment expense.
Yeah.
It would be deemed an entertainment expense, so specifically.
Because you're entertaining somebody.
Right, because you're entertaining someone, and they specifically talk about sports tickets and sporting events as far as the rule.
It's not
In the
sure.
legislative history.
And what about business clubs like the Union League and stuff
Yes,
like
the
that?
stay, no, no.
They're gone now.
Yes,
Gone.
absolutely.
Other than the meal costs. it's-
Yes, the meal there, if you take someone out to dinner. Yes.
Gifts to clients, are gifts to clients?
There's a minimum deduction for gift for clients. I don't remember the amount, that small gifts will be allowed as a deduction. It's a de minimis number. I don't remember the amount.
So why can't you gift them the tickets to the entertainment?
Because they're more than the minimum amount, I bet. I don't know.
Shockingly small number.
Yeah. Okay. Like kind exchanges. Many of you are in the real estate business, and like kind exchanges have been around, which is a wonderful thing when you want to sell your property and purchase another one. That's still good. However, remember, Pennsylvania does not allow this. Now, like kind exchanges only qualify for real estate. So any personal tangible property or intangible property does not qualify for like kind exchanges. So what happens now when you go and buy a new car and you trade in your old one? That used to be a like kind exchange. Now you sell your old one, you buy a new one. I don't think it's that big of a thing, but real estate is the only thing that is allowed. Here is a complicated thing that we need more clarification. All businesses, this applies to all businesses, except once again for businesses if gross receipts are less than $25 million. There's a limitation on the interest expense. Businesses, as a rule, are able to deduct all the interest that they incur running their business. Now there's a limitation, and the limitation is you can deduct your interest expense up to the amount of the interest income that your business makes plus 30% of your adjusted taxable income. And what is adjusted taxable income? It's your taxable income without considering depreciation, amortization, or interest expense. There are some other things, but those are the most common things. So all businesses that are highly leveraged, they really have a problem now to see what to do because they won't be able to deduct all the interest expense. It's not lost, it goes to next year, but still. So how about if you have a good year, you're able to deduct, then you have a bad year, you can deduct your interest expense. So that's something that I'm sure that there will be a lot of planning that needs to be done. So when this was talked in Congress, there was a big thing about, real estate. What are we going to do with real estate? So they adjusted this rule for real estate that if a real estate entity, and how they define it would be construction, reconstruction, renovation, acquisition, leasing, rental, and a few other things. If that entity elects to use alternative depreciation system, which is a straight line, longer life, they don't have to use that 30% rule. So instead of depreciating your office building at 39 years, you elect to use it 40 years. That's not a big deal in my mind. That's 1 year difference. How much can that be? On residential real estate, you would depreciate it 27 and a half years. Now you have 30 years. So that's not big of a thing. The only kicker in my mind is there's this qualified improvement property that I'm going to talk about in a minute, which is really improvements to the interior portion of a commercial building. And that in the code, there's 15 years, there's a little clarification that is needed in the code, but it's intended to be a 15-year asset. And that qualifies for bonus depreciation. So let's say you have commercial real estate and you spend $1 million on fit-outs. That is qualified improvement property. It meets the definition. You are able to take bonus depreciation. And bonus depreciation is huge now because it's 100%. So that's where I think that interest, you have to, as a real estate professional, real estate owner, you need to determine which is better, the interest deduction or the election to use alternative depreciation, and it's an irrevocable election once when you make it. And it appears, it's not clear, the readings, but it appears that if you used Maker's accelerated, you have to change your prior year's depreciation to confirm with this new rule. But we need more clarification on that. That's what it appears to be.
Does this have anything to do with operating lines of credit? Interest paid on operating lines of credit?
Yeah, all interest expense. All business interest expense.
So if you have a line of credit and that line of credit is in excess of 30% of your adjusted gross income, you can't deduct anything above that?
Yes, up to interest on that loan you can. the interest is deductible up to 30% of your adjusted taxable income. And then there are complications when it comes to S corporations and partnership. It's looked at the entity levels and how it flows through. We need a lot more clarification, but that's something we just want to point out to you to be aware that there's this new rule that is not too kind to anybody.
I have a question. If you own a building, it's 250,000 square foot, you're adding on a 100,000 square foot addition, that's an improvement to the property, but it's not inside, it's outside?
No, if it's outside, it's not. It has to be, I'll show you the next slide. Here, qualified improvement property is any improvement to an interior portion of a commercial building that is non-residential. So if you buy a building this year, or you bought a building, let's say 2017, and this year, 2018, you make fit-outs on improvements, that would qualify as qualified improvement property. It can't be enlargement of the building, it can't be to elevators and escalators, but for most of the things inside that you do would qualify.
But on the residential side, say you put all new windows in, you can't.
Not residential, this is commercial. Yeah. Then there's, I quickly talk about this because I think I'm running out of time. On Section 79, it has been with us for years and years. It was $5,000 deduction, $10,000, $100,000. Now the deduction is $1 million up to amount of up to $2.5 million of current year acquisitions. I don't think that that's that big of a deal anymore, this Section 179, because of its limitation and because of the new bonus depreciation, but I want you to be aware. And then there's one additional thing that they added that might be of importance, that they added qualified real property. Once again, for commercial buildings, that would qualify for Section 179, roofs and air conditioning and fire protection and so forth. Everybody wants to know about the cost. You can see the amount of you can deduct the first year has gone up. It's $10,000 plus $8,000 bonus depreciation. So, excuse me, the first year when you buy a car, you potentially can deduct, if you use it 100% for business, $18,000, which is kind of nice. And the last, I think it's the best. It's the able to expense 100% of qualifying property. It's, and that can generate a loss. There's no limitations. They also expanded that to used property. And the good thing is that this is available for any property placed in service and for which there was no binding contract in effect on September 27, 2017. So if at the end of last year you had acquisitions that qualified, they 100% deductible. So that to me is a big benefit for many businesses that has a lot of fixed asset on the acquisition of machinery and equipment.
The ordering rules for bonus in 179.
Say it again?
What are the ordering rules?
First comes Section 179. Yes, first comes Section 179 and then bonus. But I don't think, because you can take bonus almost on everything, so I think people would just take bonus. Yeah, yeah. That's what I have, and I think Scott will be next. Thank you.
Just as a comment to what Leena was just mentioning, you can understand the issue between the limitations on interest deduction and the increase in the increase in depreciation sort of makes sense, that Congress was saying, we don't want to encourage companies to go out and highly leverage their businesses to then use those to acquire assets that they could then take a 100% deduction for. So the cost of being able to get the immediate deduction was to limit the amount of interest you can deduct on the borrowings that you incur as part of your business operations. So they just, there was actually conversations during these bills about actually eliminating the interest deduction completely because of the bonus depreciation, but in effect, everyone sort of gets to have their cake and eat it too. I am going to turn to what is probably one of the most controversial provisions in the new tax bill, and one that still needs the most clarification because of the complexity added by this provision. And excuse a little cartoon, but I thought it was appropriate to talk about, because this is a provision that deals with what's called pass-through income. Pass-through income is income generated from operations in which you're an owner, in which the business itself that you operate through does not pay tax, but the income passes through and is taxed to you as an individual. Typically, you'd think of this as partnerships and S corporations, although this new law has a bit of a misnomer because it also applies to people who operate as sole proprietors. So pass-through income encompasses partnerships, S corporations, and sole proprietorship income. A new provision has been added to our tax law. It's called Section 199A. I'm not going to mention code sections after this, but this is the new provision that encompasses this new rule. It is effective beginning in 2018, and it sunsets at the end of 2025. I don't think Ed mentioned, or if he did, I missed that many of the individual tax changes in this law, other than some of the things that Leena's talked about, all have sunset provisions. So although the corporate tax rates have gone down to 21%, all the individual tax rates that have gone down are going to be resurrected to their old rates in 2026. There's only some of these things are permanent. The new rule will create a deduction of up to 20% of the income that you earn from your pass-through entities. And that deduction will be, as I mentioned here, below the line. Below the line means that when you think of your tax return on the front page, you're reporting all of your income and then certain deductions like your IRA contributions or pension plan contributions. The bottom of your front page is called your adjusted gross income. This number is going to be, this 20% deduction will be below that. So it'll actually appear in effect on the second page of your tax return, similar to where your itemized deductions appear. The reason for that is this deduction is not getting to be put into play as a reduction of your adjusted gross income, because adjusted gross income is a very important number that's used in defining limitations throughout the tax code for all kinds of different provisions. This is a very complicated provision. I'm going to basically touch on it broadly today, and I'll be happy to answer your questions as we go along, and also afterwards if you'd like to go into a little more detail. The new pass-through rule applies to non-corporate taxpayers, which means it applies to individuals, and it also includes trusts or estates. At one point during this process, trusts and estates were going to be excluded from the benefit, but in the final conference committee determination, trusts and estates were reinstated as allowable taxpayers to get this benefit. Again, this deduction, this 20% deduction, applies to qualified business income. Everything in this code section is definitional. And it is income that, again, is derived from a partnership, an S corporation, or a sole proprietorship. So what is qualified business income? Qualified business income is generally income that you derive from a trade or business that's conducted within the United States. So that means foreign operations will not be eligible for this deduction. If you have an overall loss in your qualified business income, you don't lose that loss. What happens is that loss carries forward to offset income in future years. The reason for that is these are cumulative calculations, so that you can't create a loss in one year and then shift through planning to a large income number in a subsequent year and get a full 20% deduction on that subsequent year's income without first reducing it by the losses that you had incurred from qualified income in prior years. Qualified business income is defined as what it is not. So it is income that is not investment income, which includes interest, dividends, capital gains. It doesn't include wages you receive as an employee, so you can't take a deduction for your W-2 wages, nor does it apply to income that you receive as a guaranteed payment from a partnership, which is akin to a salary that you receive from your partnership. One item when I talk about investment income, if you're in the trade or business of generating income from things like interest, you're a bank, that interest is allowed as qualified business income for purposes of these rules. So generally, the deduction amount, you're allowed to deduct the lesser of, and this is I'm starting at number 1 here because the limitations will go on and on as we go through this a bit. You're allowed to deduct the lesser of 20% of your qualified business income or 20% of your taxable income above your net capital gains. The reason for that limitation is that you can't take a deduction of 20% greater than what your taxable income is. So you can't get a deduction that's larger than 20% of that number. These rules also have deductions available for people that have investments in REITs, real estate investment trusts, that get dividends from those. Many people own publicly traded partnerships. Income from those partnerships are also separately going to be determined, but give rise to benefits under this new law. And this deduction is calculated separately for each trade or business that you are a member of, and it's applied at the individual partner and shareholder level. So it's this provision, as you'll see, is far from simplification. It is an extremely complicated new rule, but will give rise to potentially very large benefit in terms of that 20% deduction. So let's do this with an example, because I think examples are helpful here because of the complications. Suppose you have a taxpayer that has qualified income of $200,000. The taxpayer's spouse has income of $300,000. So there's $500,000 of qualified business income. If that couple's taxable income was $550,000 and it included capital gains of $100,000, the calculation of the deduction would be based on determining the lesser of 20% of their qualified income, which would be the 20% of the $500,000 or $100,000, versus 20% of the taxable income limitation, which is the $550,000 less the capital gains, because they're not included in this. So that leaves $450,000 at 20%. So the deduction for this taxpayer be limited to $90,000. Clear?
What's the arithmetic? You have 200,000 and 300,000.
So 300 plus 200 is 500,000 of qualified business income.
Where's the 50,000 come from?
550.
The 550 is their taxable income. So if you have business income, Lois, from your operations, then you have another $100,000 of dividends, and you have itemized deductions. So these are numbers I've made up, but the taxable income number will not necessarily be equal to what your qualified business income is.
Right. There's a paragraph or two between the two.
Yes.
All right.
Many paragraphs. But these are not the only limitations. There are further limitations, and these next set of limitations were put into place because Congress was concerned that taxpayers that are, say, owners of S corporations, who historically would take their profits from their S corporations and bonus them out as salary to themselves, would change the method in which they operated. Because if you think about it under the law, wages that you receive are not eligible for this 20% deduction, but your business income is. So if your S corporation made $100,000 and paid you a salary of $100,000, so it showed no income, you would pay tax on that $100,000 of wages. Under the new law, if you're able to leave that $100,000 in as a profit because it's an S corporation that income passes out to you, you could then deduct $20,000 of that income as a 20% deduction under the new law. So they had to put in a series of limitations to ensure that taxpayers can't take advantage of this by manipulating how they treat their earnings of their company. Although there's still a lot of manipulation available, they have put in the following limitations. After you do the initial calculation I talked about, you then have to further limit your deduction. And the 20% deduction, it cannot exceed the greater of 50% of the actual W-2 wages that are paid by the entity. Or, and this was again, a very complicated negotiation at the conference committee, because there are many industries which are capital intensive and not labor intensive, think real estate. Many in those industries said, wait a minute, we don't pay many wages we don't have a big payroll. Most of our income is generated from the use of our capital. So they put a separate limitation to say this limitation is based on only 25% of your wages, plus you can take into account 2.5% of the unadjusted basis of your qualified property, which means in effect, in think real estate, this is the undepreciated cost of real estate at 2.5% of that number. So that will come into play in determining the limitation on the 20% deduction. I'm sure you all got this. So
That's 50% of the W-2 wages paid by the business, not just the wages that are going into the taxpayer.
that's correct. That's correct. So and which is very important, because that's where, Michael, you can play around with, in my S corporation example, how much of the profit stays in the company versus how much is bonused out to the owner. It will depend in large part on how many employees and size of the payroll of that company. So let's, again, easy ways to do this is talk about examples. So let's assume that a taxpayer has $600,000 of qualified business income. The company that derived this income has W-2 wages of $200,000. These are wages paid to their employees, including the owner. And that their basis in their assets is, this is undepreciated, is $150,000. I'm not talking on this level about the limitation I spoke to before about your taxable income limitation. We're just going to look at this from the global limitation of your business income limitation. So the deduction that you're allowed is the lesser of 20% of your qualified business income, which is $600,000 times 20%, or $120,000, or the greater of those two limitations I spoke to before, 50% of your wages, which is $200,000 times 50% is $100,000, or 25% of the wages plus 2.5% of the property. When you do the math for that, that number is $53,750. The greater of those two numbers is $100,000, and the $100,000 is less than the $120,000, so you're limited to a $100,000 deduction for that $600,000 of qualified business income. And I'm assuming you're not further limited by your taxable income limitation that I mentioned before. You all got it? This is all the easy stuff. I haven't gotten into the details yet.
Is that real estate component across the board of all real estate you own, or just real estate applicable to that particular business?
It's on a business-by-business determination. So every individual operating entity will have to provide, think of a partnership now, and all of their partners. Every partner is going to have to be provided as part of the tax package they receive with their K-1 every year, information that's going to tell that partner what their share of the wages of that partnership are, what the share of the unadjusted basis of assets of that partnership are. This is major complication in terms of both compliance and, as you can see, calculations. But again, 20% of your business income as a deduction is a pretty hefty number for many people, so it's going to be a very valuable tax benefit.
Suppose you put in a pension plan, use up a lot of the, most of which goes to the business.
Well, if there's a pension plan that's inside the entity, that's a deduction, so it would reduce the qualified business income of the company eligible for the 20% deduction. Yeah. So all these wage limitations, again, Congress said, wait a minute, we don't want to make this too complicated for people that don't make enough money that it warrants them having to go through all these rules. So there is a provision in the law that says that that 50% of wages and that 2.5% limitations, that they don't apply to taxpayers whose taxable income is $315,000 or less if you're married filing jointly, or half of that if you're single. And it gets very complicated because it's not a cliff. So if your income is $316,000, taxable income is $316,000, you don't then become subject to these limitations. It phases in over $100,000 of income. And there's a long series of complicated calculations for that. I'm not discussing them today. No examples. Just a simple clarification so we all understand what I just said. If taxpayers have taxable income of $300,000, their qualified business income is $250,000, and there's no W-2 wages coming from that company. Under the normal rule, there would be some significant limitations, but because the fact that their taxable income is below that $315,000 threshold, they're going to get a 20% deduction on their qualified business income of $250,000, which is a $50,000 deduction against their income.
So an example would be like what, somebody owns a restaurant? I mean, so what's a QBI activity?
Qualified business income?
Yeah, like would it be-
Any trade or business.
Apart from like our businesses?
Apart from our businesses. I'm going to talk about them in a minute, Darren. As I go through one more set of limitations, which are a good segue. Thank you for your question. But so that's the general rule. Finally, I'm going to talk about one other item, then I'm going to turn over to Arthur to have him talk about some of the other items here. There are special rules for people who are in trades or businesses that are service-oriented businesses. Lawyers, healthcare doctors, healthcare providers, accountants, those in the investment world, and I'm not going to go into some of the complications here because the definition actually is much broader than this, and it's unclear what's going to constitute a specified service business, but there's a catch-all for any company whose income is derived because of the special types of services, unique skills and services of the owner that are provided through that business. We don't know what that means quite yet, and it could capture a lot of companies. For people in those industries, they do not get this 20% deduction for their qualified business income. They are excluded from the benefit. However, for those that earn in certain lower thresholds, they can get the benefit. And it's the same $315,000 threshold I talked about for the wage limitations. So doctors, dentists, lawyers, medical professionals who are earning under these taxable thresholds can get the benefit of this deduction. But otherwise, those in that industry with incomes above those thresholds will be excluded from the benefit. Again, there's also a phase-in over $100,000, which when you add these different complications in that I spoke about, these phase-ins, where you phase in the wages and you phase in these specified services, it's a whole course in math to see how it all works. So last example. Taxpayer has qualified income from a specified service business. They're a lawyer of $750,000. Their spouse has income from what their spouse does, but that's not from a specified service business of $500,000. Wages from the spouse's business are $300,000, and they have combined taxable income of $1.5 million, the couple, of which $250,000 is from capital gains. I didn't do the math here for you, but just I want you to be aware, the deduction is going to basically be limited to the spouse's qualified business income and all the other limitations because the taxpayer's income is excluded as a service business. The deduction here will end up being, if you do the math, 20% of the spouse's income of $500,000 or $100,000. Any questions? There is going to be a lot of planning involved in this provision, both in terms of partnerships, S corporations, sole proprietors, and how they're going to funnel through and deal with all of these. One other item I want to mention before I turn over to Arthur is there's another provision in the law unrelated to this qualified business income. There is now going to be a provision that's going to disallow the use of losses that are generated from a business. Typically, if you're an owner of a business that you materially participate in that business and you have a loss, that loss can be used to offset all of your other income, whether it's in the form of wages or investment income. Under the new law, this provision is going to limit the amount of that loss that you can use to offset your other income. It's basically up to about $500,000 of loss for married filing joint couple. If you have an unused loss, you can carry it over as though it was a net operating loss and can offset income from sources in future years. So, quick example. Married taxpayer has a loss from a trader business in which he materially participates of $750,000. The loss in excess of $500,000, which is $250,000, cannot be used to offset the other income of the taxpayer, and it carries forward as a net operating loss to a subsequent year. So hopefully, I apologize for being stuck with the complex section of the code to talk about, but I hope you have an appreciation that there's a large benefit out there in the business income. At the same time, it's going to be very complicated to manage, understand, and calculate. With that, Arthur, why don't you wrap us up?
I'm Arthur Zatz, and I have the honor of getting a mixed bag of provisions to try to finish up, and I'll try to do this as quickly as possible because we want to save some time at the end to talk about some planning considerations. The first area that I have to address involves compensation and benefits. And probably the most important thing in this area is the provisions that were not adopted. There were proposals to substantially reduce the benefits from deferred compensation and also to reduce the ability to contribute certain amounts to 401k plans. Those provisions were not adopted in the final legislation. One of the new provisions that was added has to do with qualified equity grants. It's probably intended for startup businesses. What it does is, in lieu of a Section 83 election, it allows an election for employees who receive stock from the exercise of stock options or restricted stock plans to defer the gain that would be taxable to them in the year of receipt for a period of up to 5 years. The provision will be very helpful to people who receive stock but no cash to pay the amount of taxes that they would owe. Whether it will be implemented remains to be seen because it's basically a provision for rank and file employees. In order for the program to operate, the benefits have to be provided to at least 80% of the employees of a business, and the election wouldn't be available to certain shareholders, officers, and highly compensated individuals. Another provision applies just for 2018 and 2019. There's a credit available to employers of between 12 and 25% for the compensation paid if the employer provides a minimum of 2 weeks of family and medical leave. And the amounts of the credit are determined by the amounts of the compensation that are paid compared to the amounts of regular compensation that would be paid as full compensation. Yes?
Is the credit in lieu of taking an expense, or is it in addition to that?
I think it's in addition to the expense. There's a change for publicly traded companies. There was and there has been a limitation on deductions of compensation to a highly paid group for compensation in excess of $1 million. And that limitation was largely avoided by companies that paid the compensation under a performance-based plan approved by shareholders and setting forth objective criteria that typically was met and the compensation was paid in the amounts in excess of $1 million. The ability to use performance-based compensation as an out for losing the deduction goes away starting this year. There's also a repeal of the ability to unwind a conversion from a traditional IRA to a Roth IRA. So in 2017, if you converted your traditional IRA to a Roth IRA when the bitcoins in your traditional IRA were at $19,000 a piece, and you had an obligation, a tax obligation, which was based on that value, and you look back on that act today and you say that wasn't really a smart thing to do. In 2017, you'd have the ability to unwind that transaction, transfer the funds from the Roth IRA back to the traditional IRA, have no taxable income for 2017, and turn around in 2018 and make the same conversion at the lower values. That ability to unwind goes away in 2018. With respect to carried interests, which are profits interests that are awarded for services from partnerships, there was an expectation that these interests would be subject to ordinary income treatment. The benefit of a carried interest is that there's no current tax, but the holder of the interest takes the view that once the interest generates earnings either on sale or pass-through of capital gain items, that capital gain treatment would be available. There were proposals to eliminate that. The ultimate provision ended with a change in the holding period in the event of a carried interest for capital gains from 1 to 3 years. It's not clear under the way that it's written. The holding period clearly applies to the carried interest itself, the interest in the partnership. What's not entirely clear is whether it extends to the assets in the partnership, so that if an asset in the partnership is sold with a holding period of less than 3 years, it may pass through to this particular shareholder as ordinary income rather than capital gains. That's the way the statute seems to say it operates, but I think there's some clarification that would needed to be given before we know the true answer. There are a number of lost employee benefits. As mentioned before, the deduction for unreimbursed employee expenses, tax-free moving expenses. With respect to employee awards, the new legislation codifies what was the IRS position, that the exclusion of an employee award would only apply to tangible property, the typical gold watch situation, and not to cash payments or cash equivalent payments. And the provision now clearly states that gift cards, vacations, meals, lodgings, tickets to sporting and theater events would no longer be excludable by the employee if given as an award, but would be taxable during that period.
Excuse me. So if the company awarded their top producer and sent them to Orlando, would the employee has to pay a tax on it?
Yes.
That's no gift.
Is there some de minimis level, like if you get an employee of the month gets a $10 gift card or something like that, that's still in de minimis?
Yeah, there are certain de minimis things, but they really are de minimis. Yes.
Many of us who have gotten older don't go on these timeshare things that we bought 40 years ago. So you give them to employees, you know, Honolulu, Orlando, someplace. I would deduct that as an expense of the business, as the owner of the business. They could be worth anywhere from, with airfare, anywhere from $3,000 to $8,000. Now what happens? Very simply, what happens?
They're taxed on it.
So I give somebody a trip to Hawaii and I say, oh, by the way, you have to pay taxes of $8,000.
Yes.
On the $8,000.
Yeah, now you might argue that the value is less, but...
Yes. So then I have to go to the casino, get the cash, and give them the cash with the gift. Right, okay.
How does that apply to year-end bonuses?
Well, year-end bonuses are compensation.
That's compensation.
Yeah, these are things that people treated as excludable. You know, if you the employee of the month got a gift card for $100. Most people said that was an excludable award, but now it's clear that would be taxable.
I assume the holiday, Christmas, or, meal, dinner out, that couldn't be taxable.
Well,
It says meals, that's what.
well, but the Christmas, the internal party.
Yeah. We're going out to a restaurant.
Is probably not.
But you always can set up a travel and events group in your company. And when you send them someplace, they have to check it out. That's work.
The planning side of it.
Yeah.
I'll tell you, I am very happy Isdaner is my accountant.
Thank you.
And you're going to make more business off of me because I have to start talking to you in around October. Right.
Can we, I want to take more questions, but I wanted to give Arthur the chance to wrap up a little bit, because we're starting to run close to our time limit, and then all your questions, then we'll take them all together at the end. Go ahead, Arthur.
There's the qualified transportation fringe, the payment for the SEPTA passes. That's still actually excludable to the employee, but the deduction to the employer is not available. Question that's unanswered is if the employee actually pays for it with just a salary deferral. In other words, the employer never puts out any money, whether the employer is still entitled to the compensation deduction. With respect to charitable contributions, again, the biggest impact is probably not the specific provisions, but the increased standard deduction, the elimination of itemized deductions, and the increased state exemptions to the extent that people who used to receive a benefit from their charitable contributions may no longer receive that benefit. But some of the specific provisions, there's an increase in the AGI limit from 50 to 60% for cash contributions, repeal of a provision that allowed you to deduct a portion of payments for seating rights at universities, a technical change in partnership basis. Exempt organizations, several changes. Starting in 2018, now exempt organizations, while they don't pay tax on most of their income, they do pay tax on unrelated trade or business income. And in the past, that income was allowed to be aggregated so that the losses from one activity could offset the income from another. The new provision requires that each activity be taxed separately. There is still questions as to what constitutes a separate activity for these exempt organizations, and that's something that will be determined as things proceed. There is a 21% excise tax on the exempt organization itself for compensation paid to the 5 highest paid employees in excess of $1 million and with respect to excess parachute payments. These are severance payments that are computed over a determined threshold. The exempt organization bears the cost of this excise tax. The tax isn't applied to licensed medical professionals for the compensation that they earn directly in providing their medical services, but that doesn't extend to things like administrative services, so that if a doctor is the chief administrator of a hospital and his compensation is for that purpose, it would still be subject to this rule. The rule was also designed to get to the compensation of athletic coaches in some large universities who receive compensation packages of $8 to $10 million a year. There's a sort of a drafting issue as to whether it would extend to to certain state universities, depending upon the structure that they have with respect to their state governmental units. But I think it's intended to apply, and it will probably operate that way either through regulations or a technical correction.
Should we try for Nick Saban per employee?
Yes, it's really the Nick Saban provision.
Arthur, is the $1 million per employee or for the 5?
Yeah, per employee. There's also an excise tax 1.4% on the net investment income of large colleges and universities. The provision applies to probably about 25 to 35 universities that would come under the definition. One that actually came under the definition was already removed by changes in the new budget legislation that just passed. With respect to exempt organizations, there were a number of provisions that didn't pass. Probably the most important was the elimination of tax-exempt private activity bonds, which exempt organizations like hospitals and universities use for their capital improvements. And there were certain changes to unrelated business income relating to licensing and logos.
Arthur, quick question. On the large endowments that you just covered a slide before, it doesn't matter how much they're taking out. So somebody's already taken out 6, 7, 8% of the endowment to try to bring it down. it's still going to get hit with the 1.4%?
Yeah, as long as they meet the definitional test, yeah. Estate and gifts, the estate gift and generation skipping exemption amounts have basically doubled, so that estates in excess of $11 million for individuals and in excess of $22 million for married couples are not taxable. The impact of this is that certain estates that had planned programs of giving to remove assets from the estate, particularly assets that might appreciate in value, will continue those programs, maybe expand them. Gifting also may be able to avoid inheritance and estate taxes at the state level, because most states don't have a comparable gift tax. On the other side, if individuals have estates that they clearly know will never be subject to federal estate tax, they may determine that it's best to just hold assets until death to take advantage of the step-up in basis that occurs at death. The step-up rules continue to apply so that at death the heir takes the property with a fair market value basis. If the property were gifted to the same person during a lifetime, they would take a carryover basis and recognize a larger gain on sale. The international provisions are complicated, and just to give a broad overview, the United States taxing system generally taxes its citizens and residents on their worldwide income, and then provides credits and exclusions in order to avoid a double tax. The provisions in the new act move toward what they call a territorial system, which would not tax foreign income, although they just move toward that end. They never really change is for all other taxpayers. The existing rules continue to apply for corporate dividends or for other kinds of income. The owners of foreign investment funds continue to be subject to the special rules for passive foreign investment companies, PFICs, and that hasn't changed. Now the change for foreign corporations is accomplished by first a one-time tax on the accumulated earnings of the foreign corporations through 2017, and then going forward with a provision or a group of provisions that provides a number of changes. Now, with respect to the mandatory repatriation, that applies to both corporate and individual shareholders, the 10% or more shareholders of foreign corporations. And it's a one-time tax on all of the accumulated income of those corporations through 2017 that hasn't been previously taxed. And the tax that applies is a 15.5% tax on the portion that's represented by cash or cash equivalents in the foreign corporation, and an 8% tax on on the other portion of the accumulated earnings. That tax is, the taxpayers can elect to pay that tax over a period of 8 years. And with respect to S corporations, the tax may be deferred indefinitely. The other provisions that operate, again, it's really a group of things of foreign corporations, are much more beneficial than the treatment to individual U.S. shareholders of foreign corporations. And depending upon individual situations, there may be some desire to restructure how individual shareholders in the U.S. hold their foreign interests. But that would have to be done by a very specific analysis. It's not clear that you should just go ahead and stick your shares in a C corporation or other structure. And I think that brings us to our planning issues.
Yes, just why don't you leave that slide up, Arthur? You can come over here. I know we're running a little towards the end here. I just wanted to raise a couple of items. Should I stand up for those? I guess there's people over there that can't see me. There's going to be a lot of planning issues that are going to be having to be considered as part of this new tax bill. A couple of things that we're starting to think about for our clients is the first question is choice of entity. With C corporations now being taxed at 21% and individual rates being at 37%, and even with that pass-through deduction I spoke about being a deduction, rates for business income in general will be higher than that 21% rate. Does it make sense for everybody to become a C corporation again? We think the answer as we start going through this process is going to be one that's going to lead to the conclusion probably not. But it's a consideration has to be looked at on basically a company by company basis in some ways. For those corporations, for individuals that are operating companies where they're having profits that they're bonusing out or distributing a good portion of the earnings, if you're a C corporation, there'd be a tax 21% on that income, and then that distribution out would be a taxable dividend to the shareholder, so there'd be double tax on that income, which in effect would be greater than the income if that company operated as an S corporation or a partnership and flowed through its income. So in cases where our clients are predominantly taking a good portion of their earnings out of their companies, retaining a flow-through structure is most likely more beneficial. For companies that want to reinvest all their money and leave dollars in, it's worth the consideration to determine whether maintaining an operation as a C corporation may make some sense, although it's, again, it's not clear. You don't get basis increases for the profit, and when you sell, there could be a larger tax on the back end because you'll have less basis in your company. So again, it's not clear just because the rates have come down that it makes sense to make that choice, but it does have to be looked at. Reorganizing operations. I talked about the fact that certain types of income is subject to the 20% qualified business income deduction and some isn't. It's unclear right now, but with the way the legislation's written, if you have a ophthalmology practice where the ophthalmology practice is providing medical services where the income would not be subject to the deduction, but you can walk to the next room after you have your eyes examined and you can pick out and choose and buy new lenses and new glasses. So they're operating a retail operation, which is not a medical practice per se. If they have those combined in one entity, it may be that they're going to lose the benefit of the deduction on the profits from that side by virtue of there being a service business on the other side of the hall. So these types of reorganizations are going to have to be looked at. Bunching of deductions. With the new standard deduction being as high as it is, and for many clients, they may not be itemizing their deductions, so there will be a premium possibly on looking year to year to possibly bunching deductions in 1 year to get a maximum benefit versus spreading deductions out over time. For those clients that are making who are over 70 and a half and taking money out of their IRAs as required minimum distributions, the law allows them to contribute up to $100,000 annually directly to a charity. So in lieu of taking the money out of the IRA directly, they can direct the IRA to make a dollar deduction, a contribution to a charity. That causes that amount not to be brought in as taxable income to the IRA recipient. They don't get a deduction for it, but they're not paying tax on it. In the new law, if you're not going to be itemizing deductions, so you're going to lose the benefit of some of your charitable deductions, using your IRA may be a good vehicle to start to direct some of your charitable contribution numbers. You have to, again, look at your personal situation to determine whether it makes sense to do that. Yes?
That provision also satisfies your minimum distribution requirement, and it reduces your adjusted gross income. Reducing adjusted gross income is like losing weight. It has a lot of different benefits, and it can help increase the amount of non-taxed Social Security, increase medical deductions, and a number of other credits and deductions that may become available if you can reduce your AGI.
And lastly, as Leena spoke about the fact that counting method changes now can be modified for companies with incomes of gross receipts of under $25 million and new depreciation rules, there's going to be a lot of corporate planning to determine whether companies should be looking at making counting method changes and planning their acquisitions to maximize their deductions. We'd like to, I'm sorry again for going a little late. I know it's a lot of material. We hope you've enjoyed this, but we are here for questions. If anyone has any group questions they'd like to ask, otherwise we're staying here as well. Larry?
The IRS going to monitor all this?
Well, with the reduced budget, the IRS will be, the big issue is going to be how quickly the IRS is going to issue guidance on many of these provisions that are, as Arthur spoke about, ones that we need guidance. I spoke about ones that need guidance. There's a lot of uncertainty as how things are going to be applied right now. The Secretary Mnuchin yesterday announced that a loophole that existed in the carried interest provision that I believe, was it Arthur that spoke about, the 1 to 3 year holding period, that the IRS is aware now of activities that are taking place in Delaware for carried interest, and they're going to go and close that loophole. If you're interested in what that is, let me know. I can explain it to you. Michael?
You were talking about choice of entity issues. The business income deduction is a personal thing, and that goes away and it sunsets and whatever it is.
2026.
Right. So it may be that in the short term that the choice of entity might be better for a pass-through, but over the long haul, because of the permanent 21% tax rate on corporate entity, it may be better.
As I said, it's going to be a very company-by-company determination, and a lot of it's going to depend on how much of the income of the company is being retained versus typically distributed out. Yeah.
Is the charitable gift of appreciated stock still in place?
Yes. Thank you. I like easy questions.
Yes. Was this a good seminar?
Yeah, that's for you to decide. We hope it was. Please fill out the evaluations that we left at your table. We do want your feedback, and if there's topics or areas that you'd like more information on, or that you think we should run other programs on, let us know. We're happy to do so. Thank you all for joining us. And don't forget to sign the CPE sheet if you're eligible for continuing education for accountants. Thank you.
Questions. The capital wants to